Hello everyone, and welcome to our video on discounted cash flow. My name is Daniel, and in this video, alongside Louis, we will take you through DCF analysis, looking at both the theory side, which I will cover, and Louis will work through an example DCF model in the second part of the video. Let's get right into it. So in the theory side, we will cover the time value of money, explain what free cash flow is, and how it compares to earnings. We will also look at how to get to unlevered free cash flow and compare it with levered free cash flow. Then we will look at net working capital and what a change in the net working capital implies. Looking at the weighted average cost of capital, which is one of the most crucial variables we will look at in this video, and terminal value, and then finally round things off with showing you the last step, which is going from enterprise value to share price, because that is the ultimate finish line, as an investor doesn't buy the enterprise, but they buy shares. The time value of money is the concept that a pound sterling today is worth more than a pound you may receive tomorrow. In the context of DCF, the time value of money is the reason we discount future cash flows. We have two formulas for this, starting with future value, and that is how much will the money grow into, and that is represented by the formula present value times the discount factor. The second one, which is present value, looks at how much is a future payment worth right now, and that is represented by the formula on the right, which is future value divided by the discount factor. Now, let's look at what is free cash flow and compare it to earnings. Free cash flow per share measures a company's financial flexibility by dividing free cash flow by outstanding shares, reflecting potential changes in earnings per share. So this measure signals a company's ability to pay debt, pay dividends, and buy back stock. The future cash flow per share can be used to give a preliminary prediction concerning future share prices. For example, if a firm's share price is quite low and free cash flow is on the rise, the odds are good that earnings and share value will soon be on the rise. Now, comparing it to earnings, or you may also encounter as net income, earnings includes non-cash items like depreciation and ignores capital expenditure, which is the cash spent on assets. Whereas free cash flow represents the spendable cash and excludes non-cash related items found on income and cash flow statements, like that can be depreciation and amortization. Now, going deeper into the differences, earnings record revenue when a sale is made, even if the customer hasn't paid it yet. Free cash flow, on the other hand, accounts for the actual timing of cash entering and leaving. Unlevered free cash flow is the cash flow a company generates from its core operations before accounting for interest and taxes. It is used in financial modeling to determine the enterprise value of a firm, which we will use later on. Now, in contrast to that, levered free cash flow does take into account interest and taxes, and so it is the money left over after all of the firm's bills are paid. Unlevered free cash flow, though, is the preferred metric when performing DCF analysis, as it allows you to value the company's core operations independent of its capital structure, which, for those of you who may be unsure, is the mix of debt and equity. The capital structure of a company can change over time, whether through issuing new debt or paying down existing debt. And so when we exclude it, the valuation is less sensitive to these changes during the forecast period. So to get to unlevered free cash flow, the following formula is used, so let's go through it. In the squared brackets, we start off with the EBIT component, which is earnings before interest and taxes. also known as the operating income, and we take away the taxes. To that, we then add depreciation and amortization, subtract capital expenditures, which is the reinvestment in the business, and finally subtract the change in net working capital. And with that, we obtain the unlevered free cash flow. Following on from unlevered free cash flow, let's expand on the change in net working capital. The net working capital is the difference between a company's current assets and current liabilities on its balance sheet. It represents the company's efficiency and ability to meet short-term obligations. The ideal position for a company is to have more current assets than current liabilities, and thus have a positive net working capital balance. The formula can be expressed and calculated using different methods. One is seen on the screen. Current assets, excluding cash, take away the current liabilities, excluding debt. This can also be simplified and done without excluding both cash and debt from current assets and current liabilities respectively. Or perhaps the more narrow way of doing it is accounts receivable plus inventory take away the accounts payable. And that is more narrow as it only includes 3 accounts compared to the simplified form, which includes all accounts. But let's have a look at the change in net working capital. So when assets go up, cash tends to go down, and that is because you spend cash to buy inventory. When liabilities go up, though, cash goes up, and that is because you're hanging onto your cash longer instead of paying the suppliers. But how does this relate to DCF? Well, you will notice that fast-growing companies usually have a positive change in net working capital, meaning they are buying more inventory and waiting on more receivables, which in the end reduces their free cash flow. In your DCF model, the WACC, short for weighted average cost of capital, is arguably the most critical variable. It is the discount rate for future cash flows into today's money, or it can also be looked at as the required rate an investor needs in order to consider investing in the business. It is a critical metric to assess if a company is generating or perhaps losing value. And the higher the risk of the company, the higher the WACC, and with that, the lower the valuation will be today. Let's have a look at the formula. So it starts off with the fraction E over V. E stands for the market value of the firm's equity, or the market cap, divided by the total value of the capital, equity plus debt. And this fraction represents the percentage of capital that is equity. We multiply that by the cost of equity, the required rate of return. The cost of equity is calculated using the CAPM, the capital asset pricing model, which is the rate of return an investor requires in order to compensate for the risk of investing in the stock. And then to that, we then add the bracket D divided by V, which is the market value of the firm's debt, divided by what we previously looked at is the total value of capital, equity plus the debt. And this fraction represents the percentage of capital that is debt. So the previous fraction was the percentage of capital that is equity, and this one is now the percentage of capital that is debt. And we multiply that by the cost of debt, which is RD. And then we multiply that bracket by the tax shield, which is 1 minus the tax rate. And let's say a company is assessing an investment opportunity. If the opportunity has a lower internal rate of return than its WACC, then it should not invest in the project. And after calculating the WACC, you forecast the line items, which Louis will show you how to do in a DCF model in Excel in the second part of this video. But For now, let's have a look at the terminal value. The terminal value is the estimated present value of all cash flows beyond the explicit forecast period, which is usually 5 to 10 years. There are two methods used to calculate the terminal value, depending on the type of analysis that is to be performed. And because you can't forecast every year of a company's life until the end of time, you assume the business reaches a steady state and use one of the following two methods. Let's have a look at the exit multiple growth model. The multiples approach uses sales revenue and multiples to find terminal value without discounting. The exit multiple can be the usual multiples used in financial valuation, that being enterprise value over EBITDA or enterprise value over EBIT. The perpetuity stable growth model assumes the cash flows continue indefinitely, adjusting the discount rate, hence where the perpetuity in its name comes from. And the perpetuity growth rate is usually equivalent to the inflation rate and almost always less than the economy's growth rate. It is crucial to remember that the terminal value is a future value, and because it occurs 5 or 10 years away, you must discount it back to the present using the WACC. And using the formula you can see, that is the fraction terminal value divided by the discount factor, and the discount rate is the WACC. It is crucial that after all the complex forecasting and discounting, when you are left with the enterprise value, you calculate the share price, as investors don't buy the enterprise, they buy the shares. And to get there, we must perform what is known as the equity value bridge. First of all, let's define what the difference is between enterprise value and equity value. Enterprise value is the value of the entire business operations, or perhaps in real estate terms, think of it as the total price of the house, so the value to both you and the bank that holds the mortgage. Equity value, on the other hand, is the value attributable only to shareholders. Again, in real estate terms, think of it as your home equity. So to move from enterprise value to equity value, we apply the following formula, and that is the top one. So to get equity value, we start off with enterprise value and we take away net debt, which is the total debt minus cash or cash equivalents. We then take away preferred stock and then take away the minority interest. Once you have the equity value, the final step is simple division to find the implied share price. However, you must ensure you use the diluted share outstanding and not just the basic shares. The formula is equity value divided by the diluted shares outstanding. And the reason we use diluted share outstanding and not just the basic shares is because we account for all potential shares that could exist, such as employee stock options, convertible bonds, and warrants. So the final number we get is the intrinsic value. If your DCF says the share price is £120 and the market is trading at £100, that would suggest the stock is undervalued and the investment recommendation would suggest to buy. If on the other hand, though, the DCF says £80 and the market is at 100, then the stock would be overvalued. So that was the theory side of this video, and next up, Louis will show you how we lay out a DCF and work through an actual example DCF model.
Hello there, and welcome to the second half of this tutorial on the discounted cash flow model. My name is Louis, and I'm the head of equity research at Elphinstone Research Group. Daniel has just gone over the theoretical aspects of the DCF and the formulas used to derive the free cash flow and eventually the implied share price. And I just want to build on this and show you using a real life example of how we at least lay out a DCF and what the inputs and assumptions that go into DCF may be. So if we take a look, I've got the assumptions up here. These are just the assumptions on our discount assumptions. So that's the WACC and the terminal growth rate, the TGR. And then, if you take a look, these are the income statements, only the items that are necessary to derive the net operating profit from after tax. And then the cash flow adjustments, which bring us down to the free cash flow. So if we just stop there for a second and take a look at the forecast period, that's 2025 to 2029, so 5 years. This is where we have to make an assumption on what the revenue is going to be in the future as our starting point. So how could we do this? Well, one way we might be tempted to do it is we'll look at the growth rate for the previous year and say, well, if that was good enough for last year, it's going to be the same this year. And then I just hold down Shift, right, and then Control R to drag it along. And here we've just flatlined the growth rate for the next 5 years. Now, we probably don't want to do this because it's quite a lazy assumption. And so instead, on a separate sheet, to make it nice and neat, we could create what's called a revenue build. So if you look up here, I've called it revenue build, which is this sheet down here. But to get to it, I could go Control, left, square bracket. And so this is the revenue build, the revenue schedule. If you like a separate video on how a revenue schedule might be built up, let us know in the comment section. But just to give you an idea conceptually of what we're doing, we are disaggregating the revenue to get a better idea of where the revenue is coming from in the business, so we can hopefully more accurately forecast the growth over the next 5 years in this case. So what are the ways we might break down revenue? Well, this specific company is Victoria's Secret, which is a retail company that sells lingerie, and it does that both online and in store. So there are store sales and direct-to-consumer sales. So that's one way we might want to break it down. Why? Because it may be that those different channels of the business are growing at different rates. Another common way to break down revenue is geographically, and that's what I've done here. So international and North American. Now, when we talk about revenue, we often talk about the drivers of revenue. And if you think about it, revenue has to be the average price of one unit times the number of units sold. And that's often a way that we might break down the revenue so that we can create an informed assumption on the growth rate of one of them. Now, if we move back to the DCF, actually one way we might like to move back is going Control FN function and then page down, which will take us right until we get to the DCF sheet. The DCF itself is like the home page, it's the dashboard, and all of the inputs into the DCF come from all the other work we've done to derive our forecast assumptions. So likewise, there's an EBIT build, and there's a tax schedule, and then there's a schedule for each of the cash flow adjustments. Each of these we would be happy to create a separate video on if that would be helpful to you. But let's just assume we're already given this for this example. We get to the free cash flow. I like to keep it below, so we can just do a simple formula like this, where you add the depreciation back to the net operating profit after tax, and then we subtract our capex and our change in net working capital. Then we times that by the discount factor. Sorry, we divide it by the discount factor to get to our present value. Now, if you remember what Daniel was talking about, the discount factor, of course, is our WACC. And so our WACC, if you have a look up here, is one of our key assumptions. of the DCF. I've actually built the WACC on a separate sheet. So if we want to get to that, I can go Control left bracket, and that gets to our WACC. What goes into a WACC? Well, you know now it's the weighted average of the cost of debt and the cost of equity. There's just a few things I'd like to say about this because Daniel's already covered it. But if we take a look at the market rate, which is one of our key inputs into the cost of equity, let's just take a step back. What is the cost of equity? If you take a look, it's the risk-free rate plus the beta times the equity risk premium, and that we get that from the capital asset pricing model. Now, if you take a look at the market rate, I've chosen to create the market rate using the past 30 years of SPX return, because Victoria's Secret is a American listed company, so the average of the past 30 years of US market return seems an appropriate market rate, what the market is expecting as its return. Now for beta we can often just we can just pull it straight from Yahoo Finance is a free site. We also might, if we have access, get it from Bloomberg Terminal or from Capital IQ. But in this specific case, and this is something you might want to consider, I've actually used a average of comparable companies. And so that's what I've done over here. So this is the final thing I just want to quickly show you, is actually Excel itself has built-in financial data that you might want to use. So I just, as an example, if I type the ticker TSLA, which is Tesla of course, and I press Alt A, that takes us to the data tab, we've actually got stocks up here. And now it's viewing that ticker as a piece of financial data. I'm going to choose NASDAQ, and there. Now we've got it as a recognized ticker for Tesla. If I equal that and then I add a period, this gives us a drop down which shows us all of the financial outputs that we may want to choose from. For instance, we've got PE here, we've got description of the business, for instance, etc. But we might want to get the beta, for instance. Enter, and then that's our beta for Tesla. Now, if I want to get rid of this, make sure the formatting goes back to the standard formatting for cell, I will go Alt HEA. Control function, up arrow to get back to the DCF. Now, when we actually get to the terminal value, of course, is calculated using the formula that Daniel has been through. That is the final year of free cash flow to the firm times 1 times the terminal growth rate over the WACC minus the TGR. For the TGR, I've just used 2%, which is pretty standard. Now, debt and cash, we can get that from the free financial statements. And then that gets us net debt by subtracting cash from debt. Equity value, we see is the enterprise value minus the net debt. And I hope you can see by now that it's useful to have things all in a line in one column, because it makes it really easy to create calculations, simple calculations. Shares outstanding, we just get that off the internet. You can get it on Yahoo Finance. You can get it actually straight from the 10K of that company if you really want to. And then eventually we get the implied share price by dividing the equity value by the number of shares outstanding, because the share price is shareholders' equity and the share is a portion of that equity, a portion of that value. Anyway, I hope this video was helpful. If you did like it, please consider subscribing to Elphinstone Research Group and liking this video and checking us out on LinkedIn. If you have any requests for future videos, let us know in the comment section. And likewise, if you have any queries about the video or questions about discounted cash flow models, let us know in the comment section and we will endeavour to reply to all your comments. Thanks for watching.